Hi, everyone. Happy Monday, May 4th. I read an earnings announcement over the weekend that raised some red flags for me about the level of risk inherent in the stock market today. It was for Berkshire Hathaway, and as you know, Warren Buffett has retired, and now Greg Abel has stepped into his shoes to lead the firm. Well, he is following closely in Warren's footsteps by being a net seller of stocks for the 14th consecutive quarter. The firm has now built its pile of cash and T-bills to a new record high of $380 billion. And this is nearly three times the $130 billion that the firm held back in 2022. So why should you pay attention? Here are three reasons. First, Berkshire Hathaway's returns over the period of 1965 to 2025 were almost double the S&P 500's. Berkshire had a return of between 19.7 and 19.9%, while the S&P only delivered 10.4 to 10.5%. Second, they are often viewed as a bellwether for the U.S. economy, and they're very picky when choosing stocks or businesses to invest in. They would rather sit on cash than take a risk in stocks or businesses that they don't think are worth buying. Third, the firm is known for having great insights into valuations, and they have guided their perspective based on what's known as the Buffett indicator. This is the total stock market value divided by GDP, and Buffett has famously said any reading above 200 means we are playing with fire. And it currently sits at 226 to 232%, which is 75% above the historical long-term trend. And it also exceeds the levels we saw during the dot-com bust. And my 2 cents is that this behavior tells us that Berkshire Hathaway sees the stock market as being extremely expensive right now. So the firm has positioned itself with cash so that it can make investments as soon as it deems those investments to be worth buying. So positioning your portfolio to mitigate risk and align to your risk profile in a similar fashion may make some sense. Let me know your thoughts in the comments, and please like, share, and follow for more updates.